Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 tech standout stocks that are trading at least 15% below their highs to consider buying and holding for the long term. In those 3 stocks are Adobe, Apple, and Block, which is formerly known as Square. Even though it's changed its name for a while, it's still just odd to say Block. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 tech stocks consider buying that are trading solidly below their highs, I just want to go over the broader market to give a sense of why we're taking a look at these 3 stocks and consider buying them and holding them at these levels. So the NASDAQ and the S&P 500 fell on Tuesday, driven by big drops from Apple, Microsoft, and a lot of these other mega cap tech names. And the selling appeared pretty unavoidable at the moment. It's actually a good sign to see the NASDAQ and the S&P 500 take a dip. The NASDAQ closed right at its 21-day moving average and around neutral RSI levels. And that 21-day had really proved to be a bullish line of support rather often since the market first rebounded big off those October lows. And sure enough, as I'm recording this on Wednesday afternoon, the market saw a solid bounce with the S&P 500 up about 1% and the NASDAQ up about 1.1%. So it bounced off that 21-day moving average. Obviously, there could be still more near-term selling. We could maybe head down to the 50-day at some point in the next couple weeks or a longer-term moving average. And it's good to see these periods of selling because it shows that the market's not in total exuberance mode where it's just going to race higher. These every once in a while pullbacks are better than straight up and then straight down a little bit later. So it's good to see that to just slowly help recalibrate things. And it's worth also noting that amid all of these fears about a return to the dot-com era, 3 of the 7 so-called magnificent tech stocks are trading at levels that might be enticing for long-term buyers. And despite that exuberance in all this AI-driven explosion, stocks like NVIDIA and others, that's really, though, actually boosting their earnings, it shows that we're really nothing like the dot-com era because stocks like Apple are trading 15% below their highs and their earnings appear to be, or like forward earnings ratios appear to be severely discounted. So that's why it's probably worth taking a look at some of these longer term opportunities in tech, even though so many people are talking about dot-com era bubbles. It just doesn't really appear that we're there at the moment. So with that in mind, we're going to take a look at the first of these 3 stocks, and that is Adobe, which trades in the ticker ADBE, and the company's trading roughly 20% below its all-time highs heading into the release of its Q1 fiscal 2024 earnings results on March 14th. So let's kind of just dive into a little bit about what Adobe does and then why it's still kind of beaten down and underperforming, and then why maybe you want to consider buying it for the long haul. So Adobe's industry-leading creative software has kind of become irreplaceable and invaluable to everywhere from companies and schools to movie studios and beyond. Its offerings range from Photoshop and Premiere Pro to Illustrator and Lightroom. On top of its core design-focused software, it's also expanding into more traditional areas of business-related software, PDFs, e-signatures, things like that. As I said, the software is so important and such a mainstay in the industry that it's used by Hollywood movie makers and giants across the creative world to your average high school student in a classroom. So that's just how prolific its offerings are and how widespread they are. The company sells, as I said, the must-haves on a subscription basis, and its pricing levels are solid, and it offers various bundles as well. And the subscription model kind of transformed Adobe about a decade ago into a shining example of impressive, steady top-line growth. And it's also rolling out some artificial intelligence features, we should note, in Photoshop and other of its software. Still, though, investors are nervous that AI is going to kind of eat some of its lunch, so to say, that various companies who are rolling out AI efforts are going to be able to have people kind of just auto-generate various images and creative ideas that maybe people would be doing on their own in Adobe. So it is worth noting that that's a broader fear at the moment, but Adobe is trying to address that by rolling out their own AI features into their various software. And then on top of that, investors are worried about slowing growth in general, and were disappointed that the company had to scrap its planned acquisition of Figma back in December, as it just faced regulatory headwinds that it knew it wasn't going to get through. So it had to just back away from that deal. So that's kind of the broader reasons why investors are a little nervous. Slowing growth on the top line, worries about AI features more broadly taking away some of the power of its own services, and then it had to back away from a deal that could have helped grow in the future. So with that in mind, the company has cooled down over the last 2 years already. It went on a stretch of 15 to 25% revenue growth for a long time. But then it posted 10% expansion in 2023 and 12% top line growth in 2022. So a solid slowdown from periods where it was growing 25 to 15%. But still, it's posted 9 straight years of double-digit revenue growth. And we're calling for another 10% growth in 2024 and then 12% growth in 2025 on the top line, to go from 19.4 billion last year to about 24 billion next year. So steady double-digit top line growth, sort of along the lines of the Microsofts of the world, where they're doing that low double-digit revenue growth, 10, 12, 11% growth. So that's where Adobe is going to be, seemingly, in the future. And then that's why, obviously, investors want to see it growing on the bottom line as well. So the company is expected to do 11% revenue or adjusted earnings growth this year, and then another 13% adjusted earnings growth next year. And its positive earnings revisions helping land a Zacks ranking number 2 buy at the moment. And it's topped our bottom line estimates for 5 years running. And then more broadly, Wall Street's still really high on the stock overall, despite some of these fears, with 22 of the 29 brokerage recommendations that we have sitting at strong buys, with only 1 sell rating in there. And then overall, the stock's up about 2,600% over the last 20 years. This blows by the broader Zacks tech sector, which is up 540%. And it's up 700% still in the last 10 years to more than double tech, which is up 280%. But it's underperformed the tech sector over the last 5 years, up about 113% versus 130%. And that said, though, even though it's trading about 20% below its 2021 highs, it has climbed 90% from its low. So it's already on the comeback trail, but it still has 20% upside even to its most recent highs, which is a solid sign. And then in terms of its technical levels, it fell recently, so it's now trading directly below its 200-day moving average and near some heavily oversold RSI levels on a 1-year time frame. And then if we look more broadly, it's still trading above its 50-week and 200-week moving average, which is a solid sign, and at some rather oversold RSI levels on that 10-year time frame. And we should note that the 50-week crossed above the 200-week moving average not that long ago, which is a bullish indicator if you're into the technical world of investing. And overall, it's trading at a 60% discount to its highs at 36.7 times forward earnings and 5% below its median. That might still be a little rich for some people's blood, but the company is clearly focused on improving its bottom line and rolling out more AI efforts. Some, though, might want to wait until after Adobe reports to see its guidance and then see how the company is addressing some of the issues that Wall Street's a little bit nervous about at the moment. And now the next stock up is a stock everyone knows. It's still one of the world's most valuable companies. And it might not be doing as well, though, as some people just kind of think when you hear all about this Magnificent Seven at new highs and driving the market to records and the NASDAQ hitting brand new highs. Apple's actually trading about 13% below where it was just late January and nearly 15% below its December records. Wall Street's really worried about various downgrades of the iPhone maker based on concerns about slowing growth in China and other headwinds. A March 5th report that's kind of all over the place at the moment now is that Apple's iPhone sales in China fell 24% year over year in the first 6 weeks of 2024. And this is according to a research firm Counterpoint, as the U.S. company is facing increased competition from Huawei, which is a domestic or local Chinese maker The U.S. tech giant's chief competitor in China is Huawei in that premium smartphone segment, and that company saw its unit sales climb by 64% in the period, according to the report. Obviously, it's facing these broader challenges from Huawei in the world's second largest economy, and it's suffering setbacks in general amid geopolitical concerns in China, and that China is just facing slowing growth. So that's sort of the worries overall in China. And then investors are also worried about the companies supposedly, quote unquote, falling very far behind on the AI push compared to, say, Microsoft and some others. It might have underinvested for a while. People are now worried that its plans to scrap EVs signals that it can't do anything else but try to go all in AI now, which I actually see it as a really positive sign that it's scrapping its EV plans. It was kind of going to be a thing that was a random niche for the company. It's a really tough business to be in, the automotive world, so it's good to see Apple scrap that and move forward into its core competencies of focusing on what it does best, and that will include rolling out some more AI features going forward. So that's kind of all the bad stuff at the moment. But it does show that despite all the strength of NVIDIA for making the chips that are running AI and AI chatbot hype, it shows like setbacks that Google's facing now, and others shows that AI is not really at the moment going to be the driver in the forward-facing world just yet. So Apple still has some time to make a comeback there. And then overall, its sales declined about 2.8% in 2023. Which was its third year-over-year decline in the last 8 years. So that's nothing crazy for Apple to have these year-over-year declines. It's still running a somewhat cyclical business, which we'll kind of address in a minute. And its sales last year, which 2023 in China, dipped only 2.2%. So that's maybe why the big fear was that the start of 2024, it saw a more noticeable decline. But let's look ahead to kind of what to expect going forward. We're calling for about 1% growth in 2024 on the top line, and then another 5% growth next year in 2024. And the company already reported its first quarter results, so we should touch on that really quickly too. So the company's Q1 revenue climbed 2%, with its adjusted earnings up 16%. And the company also noted that they had an installed base of active devices that has now surpassed 2.2 billion, which was an all-time high across all products and geographic segments, with it growing. And the company also finished with over 1 billion paid subscriptions across all of its platforms, which was more than double the number that it had only 4 years ago. So that's a solid sign. These are the various subscriptions that the company is focused all in on to kind of continually to have monthly subscriptions to grow their revenue, not just when iPhones are being released. So this is its App Store, its various competitors to say Netflix and Spotify, Apple Wallet, video game platform, digital workout classes, all of that. So that's been a part of Tim Cook's push. And then the bigger new product announcement, or the product that's rolling out most recently, is the Apple Vision Pro, which are those headsets. They've said they've actually seen a lot of excitement in the enterprise world. So not necessarily also just from consumers, but organizations such as Walmart and Nike and various other places are saying that they're using Vision Pros to help with their efforts at their own company. So that could be maybe something that not all consumers get used to right away, but the enterprise level, which would actually be very good for Apple since it doesn't really have much enterprise level offerings at the moment. So that's worth noting at the time when everyone's worried about where it's falling behind, that the Vision Pro could kind of have an untapped market in the enterprise space. It's also worth noting when everyone's worried about Apple, it ended last quarter with a net cash position of $65 billion. So that's discounting debt. So just net cash of $65 billion. During the quarter, the company returned $27 billion to shareholders and with dividends and buybacks. So yeah, it's just a cash cow, and it does eventually plan to get to a cash neutral position over time, which is worth noting. So they're going to keep returning value to shareholders and then possibly exploring new opportunities to grow in other places that maybe we haven't even thought of. It's always worth remembering that the iPod and the iPhone and all of these things kind of were created by Apple, or at least they established the market that has turned it into the company it is today. In terms of price performance, the stock has climbed about 800% in the last 10 years. This blows away the tech sector, which is up about 280%. Apple is only up about 45% in the past 3 years, which is underperforming, and it's underperformed tech in the last 12 months, which means it's definitely far less overheated than some might assume. It's up just 12% in the last 1 year versus 48% for the Zacks tech sector, and it's trading 15% below its highs. It's now trading at its most oversold RSI levels over the last year. It's trading solidly below its 200-day moving average. But if we look long term, it's also trading solidly below its 50-week moving average, which is a space it doesn't hang out typically for that long. It was there for a very extended period of time in 2022 during that year-long tech sell-off, but it is worth noting that it's still solidly above its 200-week moving average. So if you want to hold out a little bit longer, maybe you could wait for Apple to pull back to there. And if it falls from there, then maybe there is a way bigger concern that the market has that Apple is going to need to address. But it's at some of its most oversold RSI levels on a 10-year time frame that it's been, as I said, over the last 10 years. So it's now sitting at levels where it was at the end of 2022 when it first went on that big run off those lows of the 2022 sell-off. So certainly if you're a longer-term investor, it might be worth considering Apple at these levels. And then on the valuation side, it's trading roughly 25% discount to its 10-year highs at 25 times forward earnings, which is actually a small discount to tech as well. So it's trading at a 25% discount to its 10-year highs and a discount to tech, even though it's been on an insane run over the last 10 years. So that's certainly worth looking into. So some investors might want to decide that they're going to wait off on Apple and see how it addresses these concerns, and that's very valid. But certainly some of the valuation-wise and technical levels and the fact that it just has all this cash and still this massive user base, it's really worth considering maybe dipping your toes into Apple, especially if you're not already an investor. And last up is Block, which trades in the ticker SQ. As I mentioned at the top, it's formerly the company known as Square. It's tumbled over 70%. It's still down 70% from its peaks. Wall Street dumped the credit card reader turned financial tech standout based on higher interest rates, slower consumer spending, tough to compete against periods, increased competition, and various other things. When you have headlines like this in the Wall Street Journal from the fall, one of the headlines was Block stock prices down 80%, enter CEO Jack Dorsey. So the payments company has seen Jack Dorsey, who is the CEO, kind of step back into the forefront of the company. He's trying to address more concerns and turn things around. So let's kind of jump into the business and then see maybe why it's worth considering as a longer term play with it trading 70% below its highs. Its portfolio includes various point of sale offerings, broader payment and software infrastructure, business loans, peer-to-peer payments, Bitcoin transactions. Its goal is to kind of be that futuristic digital native banking and financial services company all rolled into one for both consumers and businesses. So a lofty goal, but it's done a pretty good job of that. It's kind of revolutionized that broader fintech world that had been like one of the hottest spaces on Wall Street. So it got a little bit maybe ahead of its skis in the sense that it acquired that buy now pay later company Afterpay for $29 billion in all stock deal back in early 2022. Wall Street really feared that it overpaid for that, and it certainly seems like it did at the moment. That buy now pay later space has been hammered. All the companies who were going to go public in that space have seen their valuations cut, sometimes more than in half. So that certainly did not help the company at the moment. That could end up being something they regret, but that's now kind of priced into the stock at the moment. Block is also, it's worth stressing over and over that it's coming off an impressive top line growth that was really going to be kind of impossible to match. So it did about 30% growth in 2017, 50% growth in 2018, 42% growth in 2019. And then it did 102% growth in 2020 to go from about 4.7 billion in revenue to 9.5 billion. And then it did another 86% growth to get all the way up to about 18 billion. So in 2 years, it went from $4.7 billion in revenue to nearly 18 billion. Just with that insane COVID boom, it was just kind of impossible to compete against that. That COVID economy just changed everything overnight. Block was the big beneficiary, but now it's kind of getting back into a more normal sense of how the economy works. And after a down year in 2022, it saw its sales decline about 1%. It bounced back in a big way last year. So in 2023, it saw its sales jump 25% to kind of get back on that growth track. So looking ahead, we're now calling for 13% revenue growth in 2024 to get up to about 25 billion in sales, and then another 12% growth next year in 2025 to get up to nearly 28 billion in sales. So the growth is still there. It's just not that rapid growth that Wall Street had come to expect. And it would have maybe had a more normal growth trajectory where it was still doing 40% growth instead of those back-to-back years of massive growth that was never going to be able to be replicated. And then on the bottom line, we're calling for about 64% adjusted earnings growth in 2024, and then another 31% adjusted earnings growth next year. And that's what investors want to see, is this stable top line growth of low double digit growth, 10, 12%, accompanied by huge bottom line growth. So that's what the company's trying to offer here at the moment. The company's earnings revisions activity has it landing at a Zacks ranked number 1 strong buy at the moment, which is a positive sign. And it's part of a industry that sits in the top 33% of over 250 Zacks industries. So that's another positive here for Block. And then in terms of brokerage recommendations, of the 40 brokerage recommendations that it has, 29 are sitting at strong buys with only one strong sell and no sells at all. So still Wall Street's really high long term on the stock. It's just dealing with these headwinds. So it's currently trading about 14% below its average Zacks price target at around $76 per share, and still 70% below its 2021 peaks. And it's down about 21% in the last 2 years. This is while the broader tech sector's climbed 31%. That said, though, it is a positive sign that the stock's up about 90% off the market's October low. So it's trending in the right direction, and it popped again following its earnings release. But overall, the stock's kind of trading at various levels of where it was in 2019 and 2020 before the COVID sell-off. So if you're a longer-term investor and you have a little bit of risk appetite, it's certainly maybe worth considering Block at these levels. It's back above its 50-week moving average and above its 50-day moving average, but still below its longer-term 200-week moving average. Its forward earnings multiple still kind of out of whack, so that's also could be a warning sign to investors that it needs to see more growth on the bottom line before you jump back in. But it's trading at just 1.8 times forward sales, which is a 60% discount to the tech sector. And if you look at its PEG ratio, which factors in its longer-term earnings growth outlook, it's now at 2.2 versus tech's 1.9, and it's way below where it was even a year ago. A year ago, it was trading at 100 in terms of its PEG ratio. So the valuation levels are looking much better when you're looking at forward earnings than they were not that long ago. So certainly worth considering scooping up Block at some of these levels, even though there's definitely still some risk. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.